think that we can start. So welcome everybody. So today we have Babus from Washington University and Claire Célérier from University of Toronto will discuss the paper. So we invite you, like to put your camera on if you can. And if you have like any question during the seminar, so put them in the chat. So we'll pause like for questions like every 10 minutes. And at the end, if we have time, so we can also have more discussion. So also like know that like the next seminar will be in 2 weeks. So you can check out like the WEFI website for that. And yeah, so Anna, so the floor is yours.
Thank you for including our paper in the program. As I was mentioning in the preamble, this paper is always in flux, so feedback is very welcome at this stage. This paper is co-authored with Matias Marzani, who is a PhD student at WashU, and Sara Moreira at Kellogg. I think Sara is on Zoom, and she will be taking the chat questions. Okay, so we all know that firms rely a lot on external finance to fund different projects and to promote growth. And one of the main tools that they have to raise external funds is to issue securities. In fact, firms have a lot of choice in what type of securities they issue, and this is largely owed to a surge in financial innovation that occurred between 1985 and 2014, in which period the set of financial products has expanded from about 150 types to close to 800. So the way we think about financial products in the context of this paper is essentially as products or technologies that allow firms to convert their cash flows into some set of cash flows for investors. And in this conversion, so they sell these financial products to investors, and then they get the funds or proceeds from these financial products that they later will use to invest in their own projects or to fund their own needs. I think so. The fact that firms are not indifferent to their capital structure, this has been well known since we passed Modigliani and Miller. But the fact that there is actually substantial heterogeneity in the type of financial product that firms issue, perhaps this is a bit less well known. So once we look at the granular data, then we uncover that firms use different type of financial products, and not all firms use exactly the same types. So in this figure here, we plot firms that use different financial products. So for instance, a dot represents a firm in a particular sector of the economy that issue a distinct financial products. We rank financial products based on the number of sectors that they are using. So at the left bottom corner here would be financial products that are used by many sectors. And at the right bottom corner would be financial products that are used by very few sectors. And we also ranked sectors based on the number of products that they use. So again, at the bottom left corner, we have sectors that use many financial products, and in the top left corner, we will have sectors that use very few financial products. So one thing that comes out from this picture is, to us, this picture basically communicates heterogeneity in how firms adopt financial products. So some financial products will be used by many firms across all sectors of the economy. And these are financial products that I think are things that everybody is familiar with, like common shares or bonds. However, there are many financial products that are used very sparsely, only by firms in certain sectors of the economy. And to make things more, even more complex, we will have that actually firms that use, or firms in sectors that use the most common products are going to be also those firms that use few products, while those sectors that actually use many products will be those sectors or those firms that that use the products that are actually issued more rarely. I can pause here to take questions, since I think this figure has not necessarily been.
I don't see any question in the chat, so it's clear.
Okay. Yeah.
Hi, thank you. Very interesting so far. Just one quick question. The whole security design literature that started in the 80s and 90s started from Modigliani Miller. Then we introduced frictions, and those solved the frictions. Now, what you're saying, I believe, and correct me if it's wrong, is that different sectors have different frictions. Otherwise, why would they use financial products? We go back to Modigliani Miller, you need frictions to justify any financial products. And I'm not sure that that you're approaching it that way. I looked at the paper, you're looking at the numbers rather than what frictions drive the different, the different financial products that firms and sectors.
You're right. So we take it we take this as to be an equilibrium outcome. So we take the fact that so many products exist. It must be that they actually are. There is a role for these products there. Yeah. We don't really, in this paper, we are not going to really explain why so many products have been innovated. What we will be focusing is on trying to understand what's the role of innovations in the set of financial products. So what does it mean that the set of financial product has expanded so much over time, and how that affects the firm's ability to access funds? Yeah, that's a focus of the paper. But yes, we do take it as a given that these products exist, because perhaps there are some underlying frictions that they're trying to solve. Okay, so that is in the main question that the paper is going to focus is try to understand how innovations in financial products is going to affect firms' ability to actually access funds. And this is motivated by, or this question is, there is a literature in non-financial products that show that increasing variety can encourage productivity growth. So that allows us, that essentially raises the question, does financial innovation plays the same role for firms? And the way we are going to approach these questions is by building a model in which issuers are going to decide which financial products to issue, and they are going to allow financial products to have different quality. So issuers are going to choose among the set of products available to them, and this is going to allow us to say something about the allocation of products across firms. So we're going to be able to infer a distribution of firms across the different financial products. We are then going to use the model to do a variance decomposition that's going to allow us to tease out the role of financial innovation. What we find is that the average quality of products that firms use account for about 2/3 of the variation in the firm's success rate. And the way we measure success rate is essentially through the growth rate of the proceeds or the funds that the firms manage to raise by issuing securities. So if you take firms into different sectors, and we observe that one sector is 10% more successful in raising funds, then 2/3 of, so 6.6% of this differential success rate is explained by the average quality of financial products. Now, average quality is not observable, so the model allows us to infer this. And since it's not observable, we are going to, in the next step, we are going to try to understand and infer what average quality is proxied by in the data. So we show that actually sectors that grow more in terms of their proceeds, they use newer and more specialized products. And so newer meaning more novel and more specialized, meaning that they seem to be using those products. And this goes to Ravi's question that perhaps are actually going to be more customized to solve specific frictions in that sector. Okay. I'm going to go to the data description, the model, and then the results. But before I get into that, I want to see whether I can take any questions at this point. Okay. So our main data source is the niche database from the security data company. And this covers the entire universe of public and private issuances of securities. For debt-like securities, it's only those with maturity larger than 1 year. Between 1985 and 2014, done by the non-financial US corporate sector. This gives us about 72,000 total issuances done by approximately 18,000 issuers spread across 847 sectors. As you can see from these numbers, over 30-year periods, the average issuer issues 4 times. So the data is quite sparse. And actually, it's very skewed. So the median issuer issues actually only twice over the sample period. Because of that, we are gonna use as our unit of observation a sector as opposed to an individual firm. We are gonna rely on SDC to tell us what is a financial product. And SDC identifies over 750 financial products, distinct financial products. And some are very well known, like common shares or convertible bonds, and some will be less well known. Out of these 750 financial products that we observed by the end of our sample period, over 600 are what we call new financial products, which means that they have been first introduced or first issued after 1985. So SDC sample starts in 1970, our sample starts in 1985. And the reason why we start in 1985 is exactly to ensure that what we call a new financial product is indeed new. It's not due, it doesn't appear in after 85 because of some data introduction error or something like that. So giving a 15-year grace period makes us more confident that what we classify to be a new financial product is indeed a new financial product. So among these new financial products, some again are things that everybody knows, like senior unsecured notes or asset-backed certificates, and some are less recognizable, like cumulative convertible preferred shares. The proceeds, so again, the total amount of funds that is raised from issuing securities over time in aggregate has tripled between 85 and 2014. And this figure shows the total proceeds that have been raised by firms in blocks of 5 years. So again, we use blocks of 5 years as opposed to yearly because the data is to overcome the sparseness of data. We also differentiate between old products. So those are going to be the old products that actually have been introduced prior to 1985, and those will be in blue, and new products. So those are that have been first issued after 1985, and those are in red. Among the red ones, we are also differentiating between the products that are actually introduced in this current period. So here, I don't know if you see my mouse. Here, the dark red represents proceeds generated by issuances of financial products that have first been introduced between 1990 and 1994. What is interesting in this picture is that in terms of the total amount of proceeds generated by issuing old products, that has remained constant, relatively constant over time. However, the proceeds that have been raised by issuing new products has been increasing as a share, and in the last period of our sample, they account for more than half of the proceeds raised by firms. These proceeds have been, again, generated by issuances of varied number of securities for both old and new products. So we keep the same color coding here. So in blue, we are going to have the number of old products that have been issued in a given time period. And in red, we have the number of new products that have been issued in a given period. Dark red will be the number of entrants or the number of products that have been introduced in this particular period. So if you follow the dark red, for instance, that will tell you how exactly the innovation activity has been over time. So the most prolific period for innovation appears to be the 95-99 period, in which over 200 products have been introduced and issued. However, so not all products, however, that have been introduced in a given period are used continuously over time. So for instance, if we look at the period 85 to 89, in which roughly 160 products have been newly introduced, and we compared with 1994, only 70 of those products have remained in use in these two consecutive periods. So there is significant churning of new products over time. And in fact, the average churning rate for new products is about 40%, while for old products, they seem to be more stable, so the churning rate is much lower, it's around 16%. One question one concern that we had looking at this large number of products that I issued and used by firms was whether these products, how different these products are to each other. And for this, we try to distinguish how similar or how different two products are by using text analysis. And we essentially constructed a new data set in which we associate for each financial product in our sample definitions or characterization or descriptions. And we use Investopedia for that. So it turns out that Investopedia is a reliable source of that describes what a financial product does. And given our view that a financial product is basically this function that takes cash flows of the issuers and maps them into cash flows for the investors, the text will tell us what this function actually does. Right? So this is an example of extendable mortgage bond. So an article in Investopedia is going to tell us what is an extendable, it's a financial product called extendable bond. So the article in Investopedia tells us what an extendable bond is. So it tells us that it is a bond, it's a long-term debt security that includes an option that allows a bondholder to extend its initial maturity. So if you know what callable bonds, which is the initial that allows a bondholder to shorten the maturity, this seems to be the opposite of it. So the Investopedia article goes on and tells us more, including instances in which these extendable bonds have been used and so forth and so on. So Investopedia will give us an exact characterization or has exact entries for a subset of our financial products. Many financial products, unfortunately, do not have an exact entry in Investopedia. So in order to overcome that, we decompose them into financial products that we think they capture components of, and that have an exact entry in Investopedia. So for instance, a financial product called extendable mortgage bond that we observe in our sample does not have an exact entry in Investopedia. So we are going to decompose it as something as an extendable bond that we have found having an exact entry, and as a mortgage bond. So essentially, we think that an extendable mortgage bond will have features of an extendable bond as well as the features of a mortgage bond. So putting these two together will give us, again, a description and the characterization of what's an extendable mortgage bond. So for each of these over 700 types of products in our sample, we construct this text-based description of what the product does. And then we use text analysis to measure the novelty of each financial product. So first, we construct a similarity measure between any pair of products based on the body text of Investopedia articles. So that's going to give us, for any pair of products, it will tell us how similar they are. And they will tell us, for instance, that senior paying kind notes is very similar to senior subordinated paying kind notes, but quite distinct from lease bonds. And then we construct a novelty index for each product, which is based on the similarity with products that have been issued prior to its first issuance. So the novelty index is going to tell us essentially how dissimilar a product is, it's the inverse of the maximum similarity it has with a product that has been issued prior to it. So now for each product, we have this novelty index that ranges between 0 and 1, and this will give us a quantifiable measure of how new these products are. As we average over time, not surprisingly, the average novelty is relatively low. This basically seems to indicate that many of these products are variations, sometimes small variations of each other. However, what is reassuring for us is that the average novelty is more or less flat over time, which means that if we go back to the picture of heterogeneity I showed you in the first slides, even as we account for how similar these products are, it means that that picture is still informative. So even as we weigh products by how novel they are or how similar they are with each other, we should still observe significant heterogeneity in how firms use and issue products. Yeah. So in order to account or to try to understand this heterogeneity in the firm's issuance decisions, we are going to do, yeah.
Do you want to, so I see a question like in the chat by John. So John, do you want to ask your question directly?
Yeah, so I was looking back at the generation of the novelty index, and I don't have the paper here with me, but how many of those products don't have an entry? And then when you go into constructing the novelty by combining two other products, how much could that be driving the novelty score looking flat if a lot of these are hybrid?
So that I think the fact that we are constructing them based on blocks, that will bias down the novelty, so will make them look less novel. I agree with that, but I don't think it has an impact on how flat it is over time.
Yeah, I was just, how many are those, and what do I think of something that isn't covered on Investopedia? Is that a novel product that still hasn't gotten traction by the investor community, or it was just, I don't, again, it's probably not a
Okay,
big
so that
trend.
is a good question. So okay, so I don't remember from top of my head how many have an exact entry. It will be around 200, I guess, and the rest we construct. But to your point, extendable mortgage bond, for instance, it's one of the products that we observe that has been issued once or twice in the sample period.
So it's
So
a
it is
niche,
possible
very
that
niche, okay.
Yeah, that's right. So I am comfortable with the bias in the novelty, that the fact that it biases us down. I think the prior is indeed that these products are variation of each other. So I would be more worried actually if somehow the novelty would be too high. And in terms of the evolution over time, the decomposition into blocks, I don't think that should have any bearing on the time evolution.
There is also one question that has been asked by one of the participants to ask you and who wants to remain anonymous. So I'm going to read the question. So suppose a financial product innovation introduces complexity for the sake of obfuscating like bad quality issuers. So can you integrate this like in your model? And is there like an assumption of innovation that is strictly like efficiency improving in your model?
Okay, so then I guess that I take it that I should actually go to the model, and perhaps indeed I could address this question in the context of the model when we actually try to understand how we think about financial products and what is a good or a high quality financial products relative to a low quality financial products, or what's an innovation relative to not an innovation. In short, I would think that other than ethical questions aside, putting ethical questions aside, a product that obfuscates, it is an innovation. Whether it's a good innovation or a bad innovation, that is a different question, right? And I'm gonna talk about in the context of the model of how we actually think about high quality or low quality and how obfuscation would fit into that, for instance. Okay, so to think about the heterogeneity in the allocation of products across firms, we are going to build a model, and in which firms are going to raise funds by choosing which financial products to issue. So there will be a set of financial products available for firms, and they will choose out of these financial products which ones they want to issue. And we are going to take into account that actually issuers are large relative to investors. And that's going to be important. So there will be market power that issuers have relative to investors. And once you depart the world of common shares, this is supported very much into data. So as I said, issuances are very sparse. There are typically, like the median issuers issues twice. So there seems to be indeed a lot of very little competition across issuers when they issue new financial products. Okay, so the model is going to be static. We are going to think that the model applies to each 5-year block, and is just repeated over time. So there is one period, and the economy is going to consist of firms and investors. There will be S sectors, and in each sector there is a finite number of firms and a finite number of financial products available to these firms to issue. A firm in sector S chooses a financial product that it wants to issue, and when it does so, it's going to sell this financial product or the resulting claim to investors. The resulting claim is basically is going to generate a stochastic payoff to investors that is going to be driven by the riskiness of the firm, which we denote by theta L. And so it's going to map the riskiness of the firm into a set of cash flows for investors. The map is a linear transformation, and it's going to be characterized by these parameters X and Z, which are product sector specific. So here we are going to allow that for the possibility that the product may be a better match to a sector than it is to another sector. The firm riskiness can be decomposed into an aggregate component that is common to all firms in that sector. So it's actually sector specific, and a firm specific idiosyncratic component. Each of them has its own variance. And since this is firm specific, there will be it will be independent across firms. And for simplicity, we are going to assume that also the sector component is idiosyncratic. It's independent across sectors. We are going to denote the ratio between these two parameters X and Z as the quality of the product type. And the reason why we talk about this, or the reason why we call this the quality of the product I, is so the way we think about this is that different products will generate, for the same firm, different products will generate different cash flows for investors. So Z is going to affect the variance, and X is going to affect the expected value of this financial product, for this financial claim to the investors. So for the same firm, the resulting financial product can have higher mean per unit of risk. And if it does so, we are going to call that a higher quality product. Yeah. That's essentially how we think about the quality. The chi is going to say for conditioning on theta L, for a given theta L, or given riskiness of the firm, a higher chi is going to mean that the investors will have access to a financial claim that gives them more expected payoff per unit of risk they are taking. Hence, it's going to be a higher quality for them. Investors have, there is a continuum of investors. They have mean variance preferences. Investors are going to be segmented by product. So they will, if they are associated with a product type, they are able to trade only in product type, but they can trade across multiple firms and multiple sectors. So at the beginning of the period, a firm in each sector chooses which financial product to issue. A firm L that chooses product I then has to decide on a quantity A to supply to the market. And this is where we use that firms are large. So when they decide which quantity to supply to the market, they will take into account the quantities that other firms that have chosen the same product are going to supply to the market. So there is, think of this as essentially, in short, is just a Cournot competition with differentiated products.
Anna, sorry to interrupt. So you just have like 8 minutes
Okay.
left.
I will speed up. Okay, so at the end of the period, investors associated with each product are going to trade these financial products in a perfectly competitive market. So I'm going to quickly go through these derivations. It's not a lot. Things are relatively standard here. So investors are going to choose how much to trade, and given how much they choose what to trade, that will give us a demand for the asset. Given the demand for the asset reflected in the price of the asset. So the price of the asset is what firms actually get when they sell the product to the market. So that's how that proceeds. Firms are going to choose a quantity that they want to issue, and then firms are also going to choose a product such that in equilibrium, no firms want to change the product they issue. Okay. So the inverse demand that comes from investors is going to be increasing in the expected value that the product is issuing, and has this feature that investors can substitute across products. So there is across financial claims, not across products, I'm sorry, across financial claims. So if a firm issue is too much, or too much of this product, then that's going to negatively affect the price. And same holds for if firms in the same financial products issue too much, that's going to depreciate the price as well. That's because investors can substitute across different financial claims issued in the same product. This will tell us something about what should be the equilibrium quantity. So a firm is going to issue more if the product has potentially higher mean, less variance, as well as if the sector itself is less risky, and if there are fewer investors fewer issuing firms in the sector. This also tells us an equilibrium condition between two products that are issued in equilibrium. So one thing to note here, that even if there are many products available to firms to issue in equilibrium, not all necessarily need to be issued. That will really depend on the quality of differential quality of the products, as well as the number of issuers in the sector. Okay, so we use the model essentially to generate the total proceeds that firms in a specific sectors are going to issue. So the total proceeds are going to be a function of the average innovation or the average quality of the products issued in the particular sector, as well as a term that captures dispersion of innovation as well as sectoral risk and the strength of the demand. The strength of demand, we cannot really say much about that, so we are going to just make assumptions that it grows at the same rate across all sectors, even if it may have different levels. So that tells us that the log of proceeds, so the change in the proceeds, the growth rate of proceeds in sector S across time is going to be determined by the growth rate of the average quality of product issues, as well as by this term, which will end up being all observable. So this is a coefficient of variation of quality that actually is going to be mapped back into observables. Okay. And I'm saying that this, so what do we observe here? We are going to observe directly from the data the log proceeds. We are going to observe number of issuers, number of securities issued, and we are going to estimate the riskiness of firms as well as the riskiness of sectors using a methodology from Decker, Erasmus, and Boero. Okay. So we have an observable term, which is the log of proceeds, another observable term here. So using variance-based decomposition from a methodology from Eaton, Kortum, and Kramars, we are able to infer something about how much the quality of each product are gonna, the role that the average quality of products plays in explaining changes in growth rate of proceeds. So the idea here is that if we were to run a regression of the quality on the log of proceeds, as well as a regression of this observable term on the log of proceeds, the coefficients of those two regressions must sum up to 1. Of course, we don't observe quality, but so this regression, the first regression we cannot run, but we can run the second one, and then we can use this identity here to infer something about how quality impacts proceeds. So what we find is that the average quality under different specification it explains to about 60% of the variation in growth rates of proceeds. So again, going back to my interpretation at the beginning, if we have two sectors, we observe that the proceeds rate in one sector grows 10% more than in the other sector, then approximately 6% of this growth is due to improvements in the average quality of the products that sector that grows more is using. And this seems to be robust across different specifications that we are using. And I'm going to just quickly try to understand. Quality is not observable in the model, so I'm just we are going to try to understand which could be proxies for quality in the model. And we have two candidates, one that comes from the model, so that's the share of new financial products. The model will tell us that if the set expands, then the distribution of firms across products is going to migrate towards higher quality ones. So new financial products should predict higher quality. And the other comes from an empirical observations, which is about specialization of new products, which seems to be more sector specific than all products. So indeed, if we use what we have learned about the average quality and we can find that there is a strong correlation, or there is a significant correlation between the average quality and the share of new products that firms are using in a given sector, as well as the specialization, as well as the share of specialized products that firms are using in a different sector. I'm running out of time. Am I right? Okay, so I'm going to stop here and I'm going to conclude. We presented a model in which, or we presented a paper in which we try to understand how financial innovation plays a role in the sector success rate in raising funds. It seems to be an important component. And the mechanism through which this takes place is differential adoption of new products seems to explain most of the observed variation. And the contribution of new financial products comes from a great number of distinct products that are so specialized, seems to be customized to specific sectors. Thank you.
Thank you, Anna. So you're perfectly on time. So Claire, do you want to put your slides on and start your discussion?
Yes. Okay, great. So hi, everyone. Thank you so much for inviting me to discuss this paper, which is very related to my research on security design. And so what you see on the back is what my research assistants were doing while I was working on this discussion this weekend. And okay, so this paper starts with a data set that links product description to an innovation measure and then proceeds of firms that raise external funds. And so they look at more than 72,000 security issuance of 750 products over 30 years. And so the results are the following. It starts with a stylized fact based on this data. Proceeds from innovative securities are higher. And then the paper uses a structural model to understand what is the underlying mechanism. And so quality, which is a measure of like risk-adjusted return, is higher for innovative products. And so the result is the following. Financial innovation improves firm access to external funds. And so I'm going to tell you why I think it's a very important question before giving you a set of comments about the paper. So why do we care? So as you know, startups use more and more non-standard securities to raise external funds. And so, for example, these days, I'm in touch with the founder of a startup who is trying to convince me to invest in safe securities, which are simple agreements for future equity. So, of course, these are not standard securities. And as the FINRA says, these safe securities are in fact not safe. But if you are interested in innovation on how to start external funds, it's important to understand like what are these innovative securities bringing. And so I'm from the household finance field, so we can also relate this paper to the literature in household finance that shows that an increasing number of innovative securities has been offered to retail investors, such as, for example, exotic ETFs. And so I have a paper on structured products. And so what we observe is that the complexity, but you could also consider that this is innovation, has increased in the market for retail structured products. And so there is a big debate about the issuance of innovative securities. So it's clearly a key development of modern finance, but the rationale is still debated. So are innovative securities improving risk sharing? Are they better tailored to investor preferences? Or are financial intermediaries issuing innovative securities just to extract agency rents? But this is not that simple, because when you think about the issuance of innovative securities, we need to think about also where these funds are going. And so we need to think also about firms, and this is exactly what this paper is about. So it's not that simple. And so in fact, there might be a trade-off between like investors and firms. And so maybe some innovative products that are maybe not that good for investors, maybe they're good for funds because they allow to raise additional external funds. So if we do a welfare analysis, we need to take into account not only like the investors' welfare, but also firms' welfare in the sense like to which extent firms are able to raise additional funds with innovative securities. And this is exactly what this paper is about. And so that's why I think it's important in the debate about financial innovation. But then there is, of course, an identification challenge. And so how to measure the impact of financial innovation on firms' access to external funds. And the big challenge is to find the counterfactual. And the solution that the paper provides is to build a structural model to fit with the data. So now I'm going to give a set of comments, but what I would like to say first is that I think like the data that the paper exploits and the methodology, like using a structural model, is creative, and is maybe a good way to address this question. So about the data, so it exploits data on more than 72,000 issuances across 18,000 firms over 30 years. And so I was not sure whether it really includes all firms and all security issuance in the United States. Today, there are more than 100,000 firms with more than 100 employees. So I would expect that these firms, at a point, they would have issued external securities to raise external funds. So the number of firms seem low. Like, it would be great to give a bit more context about that. And then it would be interesting also to know, like, to which extent the percentage of firms that issue securities and raise external funds vary across sectors. So one big challenge is to measure financial innovation. So we have like this security issuance, and then like we know that firms are using different types of products, and so the challenge is to measure the innovation of these products. And so what the paper is doing a textual analysis using the description in Investopedia. And they measure the difference in the use of terms between two products. So it's a pairwise measure. And the novelty is the distance to the most similar product. And so I have some suggestions, like, for example, why not use an absolute measure of novelty instead of pairwise, so to compare like each product to the set of existing products, which you could normally do with the same tools. And so one big challenge, of course, is that so it's a very long time period. And so how do you distinguish between changes in lexicography and really changes in security design? So maybe now we are using different words to describe the same thing as 30 years ago. I would not be surprised if it would be a bit the case. And then this measure covers only 78% of the issuances. So why? And it relates also to one question that we had before. Maybe there is a selection issue when you look at Investopedia. And so I have a suggestion which is related to my previous work. Why not using a more finance approach? So like this analysis is just like looking at the use of terms, which we do, like, for example, I do that, for example, in an analysis where I look at newspaper articles and so on. But given that you're looking at financial products, why not using a more finance approach, trying to identify first build a typology of security features and then identify the different features that are embedded in different financial products. So, for example, a feature could be a trigger option, a convertible option, and so on. And then you could measure financial innovation with a number of new features, and it would be a way maybe to allow to answer the following questions. So how novelty relates to product complexity. So there was a question about that in the chat. It was not me. And so how do the different features also fit to specific sectors? Do they address specific questions? So for example, like, do firms with less tangible assets are more like use more preferred stocks or things like that? So like, I really encourage you to use a more finance approach, like to identify different features in different financial products. So standardized facts, so we want more. So I think this data set seems new, and it says a lot about like how firms are raising external funds. So in a sense, I would like more like I would be happy to have even more standardized facts. And so I think one very important one is the fact that some specific products are specialized in some specific sectors. And so we see that some specific products are issued in one or two sectors. It would be great to see what is the distance between these sectors. Is it also specialization within like 2-digit industry codes? You show that average innovation is flat, which we could expect as Anna said, because innovation is incremental. But then maybe what would be interesting to have is a weighted, average of this novelty index, because if there are more proceeds, then it should increase. And then it would be great to understand which securities are issued by which sector and why, and which features are used by which sector. So now I'm going to say a few words about the model and challenge a bit the assumptions. So the key mechanism, if I understood well, is the following. There is a finite demand from investors. And so from the investor perspective, there is a trade-off between the product quality, so the risk-adjusted return, and diversification. So investors want to have like a diversified portfolio. And so in a competitive environment, if you take the perspective of firms, it's optimal to issue securities with heterogeneous quality to address the fact that investors have a need for diversification. So you might not issue the highest quality product if you want to raise more funds from investors that are seeking for diversification. But it means that there are strong underlying assumptions, if I understood correctly. So first, it implies that investors cannot replicate securities and cannot borrow. And I think it's important that you make this assumption clear, because like it's a model of financial markets. And also another important assumption is that innovation is exogenous. And I was wondering to which extent in this paper, like in this model, in this setting, we would like innovation to be endogenous. And then the paper uses a structural model to estimate product quality. And so it's inferred from the structural estimation. But at the same time, if product quality is a risk-adjusted return, I was thinking that maybe you could price a subset of products to check whether or not it fits well with your structural estimation. So to try to capture this product quality measure. And then it would be very interesting, like whether using like your measure inferred from the model or measures that you would get with some pricing of securities. That would be great to understand what drives the quality and what explains the heterogeneous quality across sectors. And so I'm going to conclude. And so the big question is, how can financial innovation increase welfare? And so what the paper says is that by increasing firms' access to external funds. And so it shows that when we think about the welfare benefits of financial innovation, we should really think about all the stakeholders and to which extent, even if it's at the expense of retail investors, if it allows firms to raise more funds, it can benefit the economy overall. And so the paper addresses this question using like innovative data and methodology.